Hello and welcome to Finance RM. This lesson will be about crypto and savings. Firstly, we have the 50-30-20 rule. The 50-30-20 rule is a simple budgeting framework designed to help you manage your money efficiently. It divides your after-tax income into three broad categories: 50% for needs, 30% for wants, and 20% for savings and debt repayment. So firstly, the 50% for needs. These are essential expenses you must pay to live and work. They're non-negotiable. Examples include rent, utilities, basic groceries, transportation, insurance, minimum loan payments, childcare, or basic education costs. Things that are not needs include streaming services, eating out, and premium clothing. Now, the 30% wants. These are non essential expenses that improve your lifestyle and bring enjoyment. Examples of wants include dining out, subscriptions, shopping for clothes or gadgets, travels and vacations, hobbies and entertainment, and gym memberships for fitness, not medical. Lastly, the 20% is savings and debt repayment. This portion is for your financial future and long-term security. It includes emergency fund contributions, retirement accounts, investments, extra debt payments, and savings for big goals. Examples breakdown. Let's say you earn $10,000 a month after tax. Then you should put 50% into your needs, so $5,000 into that, 30% into your wants, 30% is 3,000, and 20% into savings or debt, which is 2,000 in this case. It does not necessarily have to be exactly this, but you should try and reduce your wants and increase your savings. And the more savings and less the wants, the better. Why use the 50-30-20 rule? It's simple and easy to apply. It helps you to avoid debt, balances enjoying life now versus planning for the future, and prevents overspending, whilst work for all income levels. Customizing the rule is possible, and if you have high debt, you could make it something like 60-10-30. Whilst if you have high income, it could be something more like 30-20-50, which is save more. Whilst high debt would be to spend more on needs, reduce your wants. Now, instant gratification versus delayed gratification. What is instant gratification? Choosing a reward now, even if it's smaller, rather than waiting for a larger or more meaningful reward later. Examples include eating junk food instead of cooking, spending money on shopping instead of saving, watching instead of studying, and scrolling instead of exercising. Delayed gratification is the ability to resist a small pleasure in order to get a better reward later. Examples include studying now to pass exams and get a good career, saving now to buy a house later, working hard to build a business instead of taking weekends off, investing money instead of spending on luxury. A famous example includes the marshmallow test, where they gave kids one marshmallow and told them they'd get two if they wait 15 minutes. The kids who waited and got it were found to be more successful later in life and better in studies, higher income, and education, etc. Why is delayed gratification important? It leads to better financial decisions, it helps discipline and patience, helps you achieve long-term goals, it improves health, success, and self-esteem, and reduces regret from impulsive decisions. How it connects to the 50-30-20? Because instant gratification is spending most of your income on wants, while delayed gratification is prioritizing savings, investings, and controlled spending. Ways to practice delayed gratification. Set a clear goal. Example, you want to spend 50,000 dirhams in 2 years, whilst use the 24-hour rule before buying something. Track your spending. Create reward systems and visualize the outcome. Find a balance. You don't need to eliminate everything, but be intentional. Enjoy life today without sacrificing tomorrow. The final comment is that mastering your money is not just about earning more, it's about managing what you have wisely. Use the 50-30-20 rule to control your spending and develop delayed gratification to stay focused on your goals. Both of these skills are life changing, financially, emotionally, and mentally. Now, cryptocurrency, explained deeply. Cryptocurrency is a digital or virtual currency that uses cryptography for security. And unlike traditional currencies, cryptocurrencies are usually decentralized, meaning they're not controlled by a single government or bank. The most famous cryptocurrency is Bitcoin. Key features of cryptocurrency include the decentralization, the encryption, which means the transactions are secured and use cryptographic techniques, transparency, as all transactions are recorded publicly on the blockchain, immutability, once added to the blockchain, transactions can't be changed, and limited supply, most have a cap. Blockchain, the backbone of crypto. A blockchain is a chain of blocks where each block contains a group of transactions and it's linked to the previous block, verified by a consensus algorithm like proof of work or proof of stake. Other popular cryptocurrencies other than Bitcoin include Ethereum, Binance, Solana, Ripple, Cardano, Dogecoin, and Tether. Now, Bitcoin, the first ever cryptocurrency and the most valuable one. What is it? Bitcoin is the first and most well-known, created in 2009 by a mysterious figure named Satoshi Nakamoto. This is just a name given, and nobody knows who they actually are or where they are today. Their purpose is to offer an alternative to fiat currency where people can send value peer-to-peer without needing banks. Key characteristics of Bitcoin include the total supply being 21 million, and it's sometimes even compared to gold. It's mined, meaning it's created through a process of proof of work where computers solve complex puzzles. Halving. Every 4 years, the reward for mining is cut in half. This reduces new supply, increasing the scarcity. Use cases include the digital store of value, inflation hedge, sending large amounts globally with lower fees. Why is it compared to gold though? Both of them are scarce, as gold is limited in the world and Bitcoin only has 21 million. The store of value, as it's seen as such, and gold has been historically used. They're both portable and divisible, since gold can be cut and Bitcoin as well. They're both secure, as gold is secure physically and Bitcoin cryptography. Now, finally, cryptocurrency versus crypto investment. What is cryptocurrency as a technology? Cryptocurrency itself is a means of exchange, like using Bitcoin to pay for coffee or Ethereum to power smart contracts. It's a tool, network, or payment system. The use cases include buying goods and services, sending money across borders, building decentralized applications and voting systems, and tokenizing real-world assets. What is crypto investment? Crypto investment means you're buying coins or tokens, but you're not actually going to use them, but to profit as their price changes over time. For example, as we have seen in the last year recently, the price of Bitcoin has drastically increased, almost 80%, due to President Trump's inauguration, and since then, it's only been going up. Crypto investment is a good tool and works for all cryptocurrencies, as you buy or sell them and you predict whether it goes up and down, similar to stocks, just with crypto instead. The strategies include hodling, which is buying and holding it for a long time, such as 5+ years, day trading, which is buying and selling it within short periods, within an hour or day, swing trading, which is holding it for weeks or months to try ride the trends, and staking, which is locking up crypto to earn rewards, proof of stake, and yield farming, which is providing liquidity to earn interest, and Launchpad Investing, or ICO, which invest early in new tokens such as high risk, high reward. The risks of crypto investing include volatility. Prices can swing all the way up to 20% in a day. The lack of regulation, as they can be manipulated or scammed. Hacks, such as phishing, rug, and fake coins. Exchanges can be hacked. Loss of access. Forgetting your wallet password, not your physical, but your crypto wallet, means all your money is gone forever. And it's a long 16-digit password that you should keep with you or printed somewhere. Market hype, as the price is driven by emotions more than the fundamental, and the regulatory crackdowns. Summary. Is crypto a good investment? The potential benefits are very good, as early Bitcoin investors have now made over 10,000 times profit, even more if you were there from the very beginning. Decentralized, as no government manipulation. Easy to start with just a smartphone. Open 24/7, and it's a hedge against inflation. The major risks include the unpredictable markets, the fear of missing out driven bubbles, regulatory changes, scams and frauds, and the lack of consumer protections. Tips for beginners is do your own research. Don't blindly follow influencers. Always start small. Only invest what you can afford to lose. Use reputable exchanges like Binance, Coinbase, Kraken, etc. Store securely. Consider hardware wallets, which are physical. Avoid meme coins unless you're okay with extremely high risk. And don't try to time the market. Set long-term goals if you're thinking of bigger money, whilst if you're looking for quick money, then you set short-term goals. Understand the tech, especially if investing in altcoins, and diversify. Don't put everything into one coin. A famous example of one of the most failed moments in crypto and Bitcoin history is how at the beginning a man bought when the price of Bitcoin was extremely low. Right now it is over $100,000, about 120,000, but back then it was extremely cheap. He bought 2 pizzas for 10,000 Bitcoin as sort of a joke. He just wanted to test it out. Now, had he held on to that money, he would have so much money, over $500 million today. Just from that, at that time, 2 pizzas was about $20. And if you were there from the very beginning, a singular Bitcoin cost 1 cent. So if you spent $1 on Bitcoin at the very beginning in 2009, today you would have over $10 million from just $1. This is the most successful investment possible, but now it's unpredictable, and you should always think carefully, as it's an evolution, which is high risk, high reward, and it's an opportunity for those who can understand it. The smartest approach is to learn it, understand it, and manage your risk. Make sure to subscribe and hit a like on the channel, and please comment anything you think should be improved. Thank you, and remember to be smart, stay smart, and achieve your financial goals.